Welcome to the Reimagine podcast. Each week, give yourself 30 minutes and meet the people working hard to create the future of insurance today.
We had over 100 attendees representing industry decision makers, insurtechs, fintechs, and retiretech startups that joined us not only in Hartford, Connecticut, but also virtually. So it was very exciting to see the group of individuals together. Six.
Today, we're sharing Session 3, Product Innovation. We call this How Will Key Product Categories Evolve Over the Next 5 Years? So, Laura, who was there and what did they talk about?
Yeah, thanks, Paul. We had some great speakers from PlanGap, Nuvalo, AM Best, Vitech Systems Group, Lincoln Financial Group, and the Index Standard. And there was a lot of conversation, but something that stuck out to me was the fact that multiple perspectives highlighted that technology isn't necessarily the solution, but it's the railroad to help us get there. So we look at tech as, tech will save the day. That'll come in and change everything. When in reality, it's tech plus people plus plus. So that's something that resonated with me. How about yourself?
Yeah, I was just sort of stunned with the diversity and breadth of innovation taking place in a number of different sectors. I think sometimes we all spend a lot of time focused on what's in our own box. And we forget that, box in South America may look very different than a box, the retirement product box in the United States. I think we also just heard at that event, what stood out to in my mind, very similar to your railway, is we've got to have a lot of different connections in this industry. Some of it's tech, some of it's people, some of it's regulation, especially when it comes to, our favorite subject, tontines. So anyway, I think you'll enjoy this. We have some great speakers Laura outlined. And Laura, can you hit the play button?
Next up is our product group. And unfortunately, Michelle Richter could not be here. She's got sick. Hopefully she's on Zoom. But anyway, Bruno Karn, why don't you come up and we'll be the moderator and introduce a really, really interesting panel.
Absolutely. I have to turn it on. Is it working? I have to turn it on. It'll work. All right. Well, thank you very much for joining us. At the risk of stating the obvious, the demographic environment, the regulatory environment, and the economic environment has been, to say the least, a roller coaster over the last few weeks, few decades, however you want to put it. And this has posed a tremendous place for innovation within the retirement income space. And I'm thrilled today to be leading this discussion panel with industry experts, entrepreneurs, and most importantly, innovators. So to begin with, I'd like to start with Evie. We have a lot of product expertise from various segments of the annuity space. So Evie, in terms of the individual annuity market, where do you see this market heading very soon and in the next few years? And where do you see the innovation in that market?
Well, thank you for the question. And my name is Evelina Mroczek, and I'm from Lincoln Financial. And as alluded to here, I work and lead the annuity product and market research team, focus on data, digital, and anything in between. But kind of getting back to your question, I think hearing from everyone here today, right, we all know that there's a lot of challenges in front of us, but every challenge brings an opportunity, right? I think the industry over the years has proven that we can create any, what some call product widget to serve the need, right? To address the investment concerns, to make sure we can balance the risks that we're onboarding. So we can also provide an opportunity and the benefits that we can pay down the road, right? But I think the true opportunity for innovation comes with the challenges we discussed today. It's the ability to deliver solutions that can address the needs, that can become visible in these digital tools, that are easily, I don't want to use the word benchmarked, but compared. But most importantly, they are understood by the receiving end. And here the receiving end are the customers and are the advisors, right? The advisors that are there to tell our story, that provide advice. So I think if I really think about it and bring it back, the true opportunity really becomes in simplicity. So where I see the industry going is the push for simplicity and not overcomplication of the products that we sell today.
Well, thank you. Next, going with Robin, who's SVP at Retiretech. In terms of pension risk transfer, obviously, again, annuities, again, serving lifetime income customers, but from a different dynamic. Robin, where do you see the pension risk transfer coming, and where do you see the innovation coming in the next few years?
Okay, so pension risk transfer is more broadly a technique that's used by defined benefit pension plans to manage the risk of the plan. So there's been a lot of innovation done to help plan sponsors manage the plans. Many of them, let's say over 60% of plan sponsors state that their objective is to go to full buyout, transfer the risk to an insurer. And so they have tools along the roadmap to manage it, one of which is they can transfer all or part of their pension plan to an insurer through a group annuity contract, which preserves the guarantee. Or one of the innovations is the buy-in contract, which allows the plan sponsor to keep the plan and match the cash flows, the investment risk and the longevity risk of the plan. Often that's done as a staging technique to full buyout. Longevity risk transfer market is a huge source of innovation, also primarily in UK and Europe, to manage the risks in these traditional plans, which for those who have it are just a wonderful benefit to preserve.
Wonderful, thank you. And Lawrence, you have it, Mike. Okay, you're good. Lawrence is the CEO and founder of the Index Standard, and obviously an expert within FIAs. Can you tell us a little more about the FIA market? Where is it heading, and where is the innovation in there, or if there's too much innovation, if that's such a thing?
Thanks, Bruno. So I guess firstly, my name is Lawrence Black. I'm the founder of the Index Standard, and what we do is we provide tools to try and simplify fixed index annuities and RILAs. So what we do is we rate indices, we rate FIAs, and we provide forecasted returns. Now, it's kind of funny, everyone says our product is simple, and like what we're dealing with is we're hearing these investment banks are developing indices that use mean variance optimization. They risk control. We've got some indices that have got long short, they've got VIX, and your average financial professional just does not understand. So, this industry has become incredibly complex because in these annuities, you have all these wacky, wonderful indices. And then on top of that, you've got payoffs, which sometimes, we're going to give you payoff that we're going to cap you at 10%. We're seeing payoffs that will give you 5% if the markets go up, and we'll give you 5% if markets go down. And there's just so much complexity. So, at the Index Standard, what we try and do is really help guide consumers through this by helping them make these choices. And, I think it was alluded to on the previous panel that, I think, I assume everyone here has got an iPhone, right? Or some kind of Google phone.
Yes.
That is tremendously complex, right? But we understand the benefits. And I think the insurance industry is not great at explaining the benefits. Annuities still has a bad reputation, which I think is changing a bit recently, and probably some of the COVID helped that. But we need to focus on the benefits. And what I find in my seat is too many people are trying to explain to me how my iPhone works, and with all these chips and this technology, and it's like, I don't get it. I just need to know that I can make a call. I can look up something, and then I can go to the apps that I need. So I think that's something we should focus on to try and help convey the benefits, and because these products are incredibly useful and people want them, but they're just not sure how to access them or how to buy them.
Well, thank you, and that's love the iPhone analogy. They're obviously all very complex, and same with annuities. But at the end of the day, is how do we use them effectively? So, individual annuities, FIAs, pension risk transfer. I'll save you for last, Richard, because I love your product. So, David, you have a completely different approach.
That's right.
Plan gap. And it's really starting at the root with government sponsored programs such as Social Security, and you take a completely different approach at offering retirees a solution based on that. Can you elaborate a little more? And what is plan gap essentially?
Sure. Thank you, Bruno, and hopefully it helps sort of tie a little bit about what you guys have all talked about. And Plan Gap at its core is a product invention company that helped create a new living benefit for the life and annuity space to address really the largest unaddressed fear in retirement planning in America, and that is what's going to happen with Social Security. The dependency is massive, and people are worried that it might not be there as promised. And so we believe that you really can't have a guaranteed income story without talking about what's happening with Social Security and how to protect your income stream in it. And so over the past few years, we pioneered this industry. We helped build the regulatory framework, and we've partnered with some of the best companies out there to bring products to market to sort of give people a sense of power over a program that they've paid into. They've paid all their lives. Anyone in this room, 100% certain they're going to get Social Security as promised in the retirement plan? Maybe, maybe not. But if your answer is maybe not, then you know why we're in business. And so we think this offering, this new living benefit, will expand the tent of annuity buyers. More people will be attracted into a conversation that's normally pretty complicated. And if we can make it more relevant to their real concerns on the street, then we think we can make the experience for the advisors better. They can acquire more customers, and then address that really large fear in America that the rules might change.
Wonderful. So last but not least, Richard, we talked about annuities in various different shape and form. You, along with many academics and economists, have been a big advocate on longevity pooling and the concept of longevity pooling, risk pooling. This translates right now into annuities. Is there another way? Is there an innovative way? Is there an alternative that goes beyond that could ultimately complement annuities and offer a different avenue for people seeking income and people seeking to decrease their longevity risk?
Thank you. I think the answer is yes.
Oh.
Hopefully people will actually buy it. But, quick background first. Our company is called Nuovolo. We're a startup, Retiretech. It's a B2B company. Our target market really is primarily asset managers and insurance companies as well. governments and robo-advisors, anyone who's providing services, retirement income kind of services. We talked a little bit about, defined benefit, right? So there's this issue of pension risk transfer, and people don't like the risk on their books, sponsors. So there's this big trend away from defined benefit into defined contribution that's been going on for many years now. And unfortunately, when that happens, we lose risk pooling, right? So the idea is now to bring risk pooling into the defined contribution space, right? And there are ways to do that. I think one way to think about it is like offering of a non-insured, non-guaranteed annuity, life annuity, right? That doesn't say you're going to get exactly this much money or follow a certain index payout, but just completely sharing all the risks. So there's no guarantee cost, right? So it's significantly less expensive to offer. So for people who say, you know what, I'm very risk averse, I do want a guaranteed income stream. I want to know exactly how much I get. Those people should buy a guaranteed annuity, right? For people who say, no, I want assured lifetime income, but I don't care exactly how much it's going to be every month. I'm willing to let it go up and down some in value. Then perhaps they could use something that's a risk sharing, risk pooling arrangement that offers that and could be offered in, say, defined contribution plans today using the existing investments that are already offered in those plans today, or through robo-advisors and different things like that.
So in terms of contrast what's already offered, how would you contrast this with maybe, you made that contrast with payout annuities, but how would you contrast that with, let's say, variable annuities with living benefits?
Yeah, good question. So we talked about that a little bit too, right? So a lot of these products are very complicated, right? So, and they all do have some kind of guarantee built in. So the idea here is you just say, let's just dispense with that, right? So it's similar in a way in that you could say, you are going to get a lifetime income and it's going to vary with the experience of your investments, but we're just saying there's no guarantee period of exactly how much you're going to get. So if you invest in a relatively conservative portfolio, you're going to get payouts that are going to vary somewhat over time. If you invest in an extremely risky portfolio, you're going to get payouts that go up and down along with the experience of the investment return. So it's largely about offering that kind of a thing, but with just zero guarantee.
Zero guarantee, but obviously maximum payout. So it's a trade-off.
Yeah, maximizing the payout by reducing costs, basically.
Right. Because I think we all love guarantees from annuities. I think most of us would not be in this room if it wasn't for the benefit of guarantees in terms of annuities. But there's also a flip side that's most of the time underappreciated from annuities, and that's the risk pooling. Just like there is a risk pooling for every other type of insurance, car insurance, life insurance, and whatnot. So I think that it is extremely interesting to see that we are coming out this way in terms of innovation. David, back to you. In terms of solution based on government issued programs, or should I say government sponsored programs, are there other avenues where you can actually offer or kind of replicate that offering on Social Security, thinking about potentially Medicare or anything, any of those other programs?
Great question. I know I'm in the room with, I guess, the godfather of Retiretech, right? And we like to, people smarter than us have said that we're creating a kind of a new category called retirement insurance. And so what we like to think about is all the income promises that are made to any one of us that sits off balance sheet. Pensions, deferred comp, Social Security, things that are promised to you that sit somewhere else, that you're counting on that income or those promises to be kept. And we think that there's the same application can be applied to pension income, to these other sources that may or may not be there as promised. You know, the old Arthur Anderson guys know a little too well on what happened to their deferred comp. It becomes an asset that creditors can go after. And their retirement plans changed. And so, you know, we really just believe that people that have done what they're supposed to do, kind of played by the rules as presented to them throughout their career, and then to have those rules change is kind of crappy. And they should have the ability to buy protection or hedges against those potential broken promises. And we think that really expands the appeal of the annuity and life market.
Wonderful. So maybe back to the more traditional annuities, the individual annuities, the pension risk transfer annuities. I have a question for both of you in terms of innovation. Is technology the trigger for potentially new innovation, especially within the pension risk transfer?
Yeah, sure. Well, it's an enabler. So what, I work for Retiretech Systems Group, which does policy administration systems, integrated digital administration systems for retirement plans, for plan sponsors, insurers, and benefit providers. And what you find is that the old legacy systems don't provide accurate, efficient information to the plan sponsor or the participants. So a digital platform will do all of that. It provides data, can be grabbed in any form. It's provisioned, there's automatic benefit calcs. The plan participant will have digital self-service, and other layers can be added onto it to connect to it. So the product morphs to become the product features and the service experience for the participant. If I could pivot just quickly to the defined contribution market, there's, I think, the possibility for even more transformation in defined contribution, because you need go-betweens between the record keepers and the participants to grab the data, put it in the right format, and feed it to all the parties that need to have access to it for these new innovative forms of lifetime income. So I would expect a lot of transformation in that area.
What about you, Evie? Any opportunities, tech or non-tech, in terms of?
Well, obviously, Retiretech is here to stay. I'm not going to be the one to say that it's not. But I think one of the things we have to be careful with is, as mentioned here by my fellow panelists, is that technology is not the solution, right? Technology is the railroad that can help us get there. So we really have to think about what problems are we trying to solve for our customers and what is it that they're looking for, right? We have a plethora of products, right? Annuity products that some out there are trying to simplify, yet us as carriers, we're looking to deliver things that can really benefit the customer. So I think in all this is technology is going to keep us carriers in check, especially the Retiretechs out there, looking at not overcomplicating our products, right? I think we at times forget that what we create and what might make sense behind the closed doors is not necessarily easy digestible on the other side. So those digital interfaces that will not know where to place us will challenge us to think better and think harder. So I think technology is going to serve us well to really challenge us to really look to what we need to deliver that's out there. But it also creates a way at potentially reaching the underserved markets, right? It gives us an ability to maybe reimagine how we and who do we deliver our products to, which we didn't have that before, right? We now have digital ecosystems developing that have customers looking and studying products, right? Recently, I went through supporting an immigrant parent on Medicare, purchasing Medicare policy, right? These are individuals that are non-English speaking that need to figure out how to maneuver that system. Well, there is an opportunity for me sitting as an insurance carrier to say, wait a minute, you have individuals coming in studying Medicare type coverage that are going to have to be coming in every year to come in and review their policy. Maybe that's our point of entry, right? We heard earlier that the Medicare agents are the ones that are more digitally savvy. Maybe there's an opportunity for us to think simple annuities and think about introducing our products in a new way. So I think in all, where I see the innovation happening is us challenging ourselves to think beyond our traditional channels. Of course, we have to serve those that have worked with us over the years, but also look to grow. I think all of us sitting on the insurance carrier, we always talk about growth and sales. Obviously, our goal is to expand and be here for another 115 years and for many years to come. But we have to also challenge ourselves to identify new markets. And that's the way to really survive to the future.
Oh, I couldn't agree more. That's a really good point. I mean, I've been hearing about, penetrating the middle market as a challenge for everyone, for every carrier. So definitely finding those solutions, and potentially, to your point, through technology can help that. So switching gears again, Lawrence, you back on those index. You mentioned we all mentioned the entire world is focused around ESG. Is there any way that ESG can make their way into those indices? Or if so, is it going to be driven by compliance, by regulation, by consumer demand? How do you see ESG fitting into this entire range of indices offered within fixed index annuities?
I mean, there's a lot of things in that question. So I mean, I'll talk it from a couple angles. I would say, firstly, we see ESG as a theme. And I think themes are easy to sell in the insurance space. So whether you could have a product that says, I'm going to give you a payoff link to the NASDAQ or to this fintech group of companies, or ESG or green. So I think themes are actually really helpful because they're easier to convey what's happening to the end consumer. And I would say ESG has evolved a lot. You've probably seen some of the bad press that a number of the large asset managers have got from claiming to be ESG compliant when perhaps they weren't. And we do a bit of work in Europe, and I'd say things are evolving rapidly in Europe. And my sense is what's happening in Europe, ESG is less well thought of now, because pre the Russian invasion of Ukraine, everyone thought, let's say, a defense company was not an ESG company. Now that might have changed. You might say, well, a defense company might be part of the S society. It helps keep stability. So my sense, what's happening in Europe is people are moving a little bit away from ESG as a framework. Per se, it's going to become embedded, and people are focusing more on what's called the sort of Paris goals. They want to identify companies that are, really genuinely reducing the global temperature by, 2 degrees centigrade. So that's what's happening there. And then, sort of tying back into innovation and tech, into some of your thoughts. I agree with you that I think tech is really an enabler. And one thing from our space is we have a lot of clients that are in the IMO, FMO space. And, we see regulation is coming into this industry in a big way. This has really been an unregulated industry. And now you've seen something called Reg BI come into place. And you've got another regulation called 8424. And I see a couple of nods there. That's great, where you either have to demonstrate that you sold a product that was in the client's best interest, or number two, you might even have to be a fiduciary, which is pretty scary. So I think, the tools can help demonstrate that. And we have rating reports, we have forecasts, and we're one of many tools. But at least I think technology can allow you to save these reports down, whether it's mine or someone else's. You can demonstrate that how you got to that solution for a client that we actually considered various products. We were able to evaluate them. We could look at the quality. We chose 3, we can demonstrate, save that down, and we gave the client this final one. So I think that's going to be really, really important. And I think there was a comment earlier on the earlier panel that some people are using pens and paper. I think that's still true, but technology can reduce the errors, demonstrate compliance, and really help the end consumer.
No, absolutely. Please.
The ESG, you raised a good point, is that I think it was COP26 end of last year, they introduced GFAS, which is a financial side for climate. But one thing else came out of the ESG, the perception of it by the younger demographics vastly.
Yeah.
I don't know how you're going to put an index to that.
That's so true. So I think, and it's interesting. I've been sort of crisscrossing the country in the last couple of weeks, and I think you're right. You have this age, and then I'm kind of like on the coasts, and ESG is pretty cool, and then I'm in the middle of the country, and it's dealt with a bit more skepticism. So it's, you're right. It's all over the show.
Oh, thank you. Thank you. That's helpful. Richard, obviously, a very ambitious project you have. You've worked as a consultant for governments, for privately owned companies across the world. How do you see this solution being implemented? And you see it more as a public, a private, a joint venture between public and private? How do you see the implementation of such an infrastructure here in the U.S. and elsewhere in the world?
Yeah, I think it really depends significantly on what country we're talking about. So I'll just give you a few examples, perhaps. In some South American countries, there is no annuity market at all, right? So a lot of these countries developed a defined contribution system decades ago, and some have mandatory contributions, right? So there's like very big pots. The baby boomers have approached retirement. They're ready to start spending, and there's like no good option for them to get a lifetime income because there is no annuity market, at least in some of these countries. And so the governments are thinking, well, gee, how do we get an annuity market started here, right? How do we attract that? And in many cases, it's nearly impossible because their constitution has certain requirements for retirement income that is basically unhedgeable for an insurance company. So now they're thinking about, oh, here's an alternative approach, right? So a lot of these governments also are moving further to the left, right? So the pension plan providers are lamenting this because their business may be going away, but the government may be able to provide this kind of a tier 2 kind of solution that is offering a risk pooling like nationwide, right? And they're offering it. So there might be public. We've done some work in Japan as well, and their insurance companies are really interested in this idea because interest rates, if you think it's been difficult here, right? So interest rates there are even lower than here. Longevity is even worse than here. So, the supply of the annuity market in many places around the world, including there, is shrinking and is very difficult. And so they're thinking, oh, well, here's a way that we can offer the lifetime income with like no capital reserve requirement, right? And can be done at pretty low expense, right? It's all automated, basically. So there could be insurance companies in the private market that offer this. You could also think about like an asset manager says, yeah, we love our target date funds, right? And a lot of them have very big franchises. They lament the fact that they can't offer really a lifetime income solution, right? But they love their target date solution, and they don't want to do anything to disrupt that. So we can say, well, keep your target date solution and wrap a risk pooling around it where participants, perhaps optionally, can opt in or not, right? But if you opt in and say, yes, I want to share my longevity risk with others, then they're able to offer their preferred investment solution in a way that offers risk pooling. So the people not only getting investment returns are also getting longevity credits or mortality credits, you prefer to call it that, and pay out for the rest of their life. And it could start immediately, or people could basically choose, right, when you want your income to start, perhaps age 85.
All right. Well, thank you. Now, maybe a question for the panel. Maybe not a question, but more of a kind of a, I don't want to call it a business case. But if we all think of ourselves as a society, and I don't want to rehash all of the numbers, the 10,000 people turning 65 every day, and 1 person out of 4 is going to live up to age 95 or whatever it is. But we all know that this scenario is true. If we fast forward ourselves 20 years, there is going to be a major chunk of the population that's going to be very advanced in age, and not every single one of them is fully equipped to survive, and most of them will have deplete their funds. That's a societal catastrophe. At the same time, it's not a spectacular one. It's not a building exploding. It's mostly going to be a slow bleed if nothing happens. Now, the question is, and I think we've touched on that from every single one of our panelists, but what can we do to make sure that as an industry we address that, and we make sure that society is ready for that, and we offer the right products, the right advice. I know, thankfully, we have podcasts like that Annuity Show that talk about these concepts and put those conferences together. But as an industry, what can we do? What should we do? And what type of product and advice should we bring on the forefront, or at least try to bring on the forefront? I'm hopefully we'll get an answer for every single 5 of our panelists, because I think it's a very common denominator here, regardless of where we're coming from.
All right. Well, maybe I'll take a stab.
Please.
But I will not answer that with a product. I think I would like to answer that with the open gap that's missing in education. I think what we need to do, as all of us here, regardless if we're a tech company or if we're a carrier, is really educate, the society about the risk and what does it mean, and that there are solutions out there that can solve it. And I'm using the word here, solutions, carefully, because it's not necessarily my carrier's product or any of the solutions here, right? It's the solution that's required for the person on the receiving end and what they need. So if I really had to think back on how do we overcome, bigger societal problems, is really address the fundamental need of lack of understanding of the risk we're dealing with, and really pointing folks on what does that mean for them and how are tools out there that are available to solve it. So
we don't have to go in order, but please.
Building on that, the scenario that you paint is in the future, right? Beyond the 5-year perspective we're focused on today. And by that time, you have to assume that most of the population is digitally native. And, one of the sound bites from the LIMRA retirement conference was planning your retirement is going to be similar to planning a vacation on kayak, where you have the information, the tools to form a trip or series of trips. You could argue our aging process is a series of trips with real-time updates. And there won't be one solution for all, because everybody's experiences, needs, priorities, family circumstances, and resources are different, and they change over time. And I think that, if you encourage not only the education, the access, we talked earlier today about simplicity, ease of use, portability would be, so these would be features that would be common, that you'd want to see in solutions that would be provided for future generations.
I gotta say, I feel sorry for you guys because what I was thinking has already been said. So I think you're absolutely right. Education is absolutely critical for this industry. And I think to your point, it's also about partnering with the advisors to give them the tools so that they can enable it. And I think we need to have more products. I love your solution. I think that's just what the industry needs. So if we can have more annuities, but also I think we need more support from the industry because like there's only one that annuity show, but we need more things like that because we have to get out the word to everyone out there. And there's such a negative connotation that we really have to come together and help the industry overcome that to sell more products so we can help more people.
And that's a really good point on annuities. Annuities mean so many different things. Some can accumulate, some can provide income, some can be a hybrid. There's just a lot of, it's such a vague terminology, but people tend to associate and make some sort of conclusions or find common denominators very well. So I think that's a really very good point.
You mean, all right. I came from a town, Flint, Michigan. That's why I clutch water everywhere I go. That's where I grew up. Everyone sitting around the dinner table relied on General Motors, right, to pay for the retirement plan. And I know for a lot of my friends, their parents had pensions. Their parents have Social Security. Their parents have these other plans that were bestowed upon them for participating in this work. And I think is Evelyn? Yeah. Point of education, I think the education needs to be self-reliance. And I think that is a huge opportunity for the private market, where it's education based on those systems that were relied upon in the past often don't exist right now. I mean, I have friends I know that are like, I just haven't really thought about retirement income. My parents had a pension, and I'd be like, well, you don't have a pension. And they're like, well, yeah, you're right, I guess, And so there's this chasm between a lot of our parents who had this infrastructure of retirement, defined benefit versus defined contribution, that this generation is the first generation where that rug's been pulled out. And there's some naivety in that. There's too much faith that it's going to be okay 20 years from now. And I'm here to kind of rattle that cage, I think. And maybe it is because I watched General Motors go bankrupt. I watched family who counted upon promises have those promises broke, and then witness the carnage, really, of retirement plans because of that. So I know it's true. And I think as an industry, to be able to get out front and say, I can put you back in control, is such a powerful statement to bring kind of solid footing to a retirement plan that support annuities, that support the structure and the ratings and the financial power of these great carriers. I think that is really the messaging opportunity.
Last but not least.
I don't know if I have too much else to add. I mean, completely agree. I think, may I summarize it this way by saying, I think so much depends on trust, earning the trust of our clients, which is something that's been challenging for the industry.
To say the least.
And I'm not saying that in a bad way. It's just a complicated problem, right? And so, and people aren't as learned as us, right, in these matters. So even for an actuary, it's difficult. So how do we explain some of these products or any product to someone who's doesn't have that kind of background? But so I think emphasizing simplicity, transparency, and the education, right, and making sure that I guess the other thing that in particular that we're trying to work with is this idea of fully funded, right? So your pension is fully funded. It could vary up and down over time, and it will with the investment experience and the mortality experience of the pool, but it is fully funded, right? So there is no underfunding, and hopefully that's something that's going to help earn trust in that kind of a product.
For sure. That's a really good point. And if I can answer my own question, I do believe that one part that's missing right now is income. I think, if I think of my current role as an associate director at AM Best, what we look at is, the financial strength of insurance companies. Now, where do we start? We look at a myriad of regulation and statements and actuarial opinions. But where we look at is the balance sheet. That's the number one thing we look at, and most of our answers are going to be there. Second thing we look at is the operating performance. Where is that balance sheet going to look like? So you have a balance sheet and an income statement. If I look at my prior job as an equity analyst, what drives stock prices? Earnings. So first page on the report is earnings. That's the number one thing we look at. Page 3, you look at the balance sheet because it's still still very relevant. So why am I stating the obvious? You need a balance sheet and you need an income statement. But I believe that the retirees are completely ignoring the income part of it. Everyone knows what their balance sheet looks like. They know what their mutual fund balance is, their CDs, their variable annuities, how much they're worth, how much they have. They all have a magic number. Everyone has a magic number. But how much income does that generate? How much income does that generate for the rest of your life? Yeah, no one knows. So that's the important part, and that's as important as having X amount of dollars in terms of net worth. How do you generate that income? How do you generate that income for life? That's the tricky.
There's something else perplexing with this generation of is our workforce and the way we work. We no longer devote our lives, careers, 40, 50 years to it. We're in the gig economy, contractors and things like that. And retirement, which is many decades away, is just absurd. We move from one contract to another.
That's an extremely good point. And before there was this thought of saying, well, I'm going to reach, I have enough to retire, so I don't have to work anymore. To your point, now we're saying, well, I don't think I have enough to retire, so I just keep on working within that particular economy. And when or if I get to a point where I'm comfortable, what is that trade-off between income and assets? And again, to your point, that also brings the question of, do you want to supplement your income while you're in retirement? And I think that works out very well for many people if you have that capability and that ability. So yes, all very good points. Yes.
We had this discussion earlier, but there's a guy by the name of Ken Dykewald that he's a gerontologist, behavioral psychologist, and looking at what he thinks retirement is going to look like going forward. And millennials have a very different view than some of the folks that are boomers, and just the way it looks in terms of working part-time or doing things to supplement income, both from a fulfillment standpoint as well as the income side of things. I think that's part of the whole paradigm that can be complete. Well, what does retirement mean? Absolutely.
What it means, and not necessarily thinking that the traditional way of doing things is going to be the gold standards for the next 40 years.
Let me jump in on that as well. But I think that also brings another element of danger, right? I think a lot of us, or those that with that mindset, are thinking that I'm going to be able to work part-time, right? I'm going to be able to do this. I can have fun and work, and that will be my retirement. Well, what happens if you can't work? Mm-hmm. I think that's where a lot of times the element of insurance is overlooked, right? It's this idea of every single one of us tends to look at our future optimistically, right? I think that's a human nature. We're here to look to the future, to have things better. And I think that's where us as an industry, we have an opportunity to really think about, to complement in that scenario, what does this product or our offering or as an industry we can bring to the table. It's that element that if you can't work, you can still enjoy that and feel safe. So save a little bit now to have that safety tomorrow. But I think we all know there is another element that's changing the mindset of those coming in. It's that instant gratification. Right? My kids, me as a child, doing research for a paper, I had to plan accordingly so I can get on the bus and go to the library. My kids can sit down an hour before, the night before, and say, oh, shoot, I need to do something. They Google it. They have instant information constantly. And right now, asking somebody to give away $100, $200, whatever that percentage is, to put away in the pile for something that you might use years down the road, brings another challenge. So I think that change in the mindset and the evolution of the need for instant gratification brings another challenge for us to solve.
I mean, sort of related to your point, I think this industry and the whole investment industry is all focused on we can help you invest better and make you more money, but there's very little focus on deaccumulation and better tools and helping people that if you do the gig economy or if you don't, helping people through that is going to be, it's a big opportunity and a big challenge.
Oh, absolutely. And it's a completely different dynamic. So, yes, please.
Sure.
So how young is too young? You know, where I think generation has potentially buying products differently or they don't want to buy products. So how young is too young to start educating? Talking about educational marketing is such an opportunity.
You know, the thing that always still amazes me is the magic of compound interest, right? I mean, and if you look at sort of the tail of the last 10 years of a 40-year cycle or a 50-year cycle, and I think, you know, educating, starting early, saving, and really demonstrating that is truly unbelievable when you see that graphed out. So look, I've always railed against the school system. I mean, you know, I graduated from one of the top business schools, never taught me anything about mortgages or taxes or, you know, or anything like that. So I think, you know, what happened to social economics classes, right? Like back to 10, 11, 12, budgeting, money. My dad, you know, made me mow the yard at 12 years old. So that seems like a good age to try to make some money and understand what it takes, you know, to save and allocate and then to plan. And I think, you know, creating an experience young of saving, earning, and acquiring. I think that was one of the things. I remember I was really young and I wanted new skis. And my dad made me work for new skis. But I got the new skis. And so the money was gone, but I had to save. I went through the exercise and then I acquired. And then I knew that was the path for me to then get new things. And so I think just the simple exercise that we don't really talk about, because I think to Evelyn's point, the gig economy or being able to say, hey, I'm going to work when I retire. Well, things might change. They think there's a ton of optionality. And maybe we say there's not quite as much options as you think.
Didn't you buy your first mow loaner at 14 years old? Is that
so? Yeah, my mom knew she was in trouble on my 14th birthday. I asked for a leaf blower to expand
leaf
my
blower.
services.
Sorry, I misspoke on that. So I guess 14 years old would be the.
I guess from my perspective, and I'll speak of my own children, the earliest you can start. The second they get that first $20 or $5 from their grandparents, explain to them that not all of it stays. Take a portion aside. And, you know, I did that from the moment they could really understand that concept. And right now, any other, you know, any party or anything that happens and grandparents that are willing to share, they give money. And with time, my children just come to me and say, hey, Mom, let's put this in the bank. Here's the money to go to the bank. But what I did was take it a step further. I did take them to the bank. They saw the process. It's not Mom taking it and putting it into my wallet. It's me driving with them physically to the bank to deliver and deposit the money. So it instills that appetite to do this. So I think overall, it's school age, right? It's getting that back early education to school. And most importantly, the first job, and I'll give credit to my first manager, who my first paycheck, first thing he said is make sure you put whatever the company matches, you max it on your 401k. At that point, coming out, I wasn't really thinking much about it, but you know what? Power of compound interest. It does help. So I think it's this idea of identifying the moment and bringing the education early. So I think that would be a fun, and as an industry, I think we have an opportunity to do that. We have an opportunity to bring it forward and bring it to the schools, and the next generation coming in will know to look for it.
Retirement actually look like today? What do you think retirement actually looks like 20 years? And the third question is, do you think retirement will be retired? So in other words, when I'm listening to you, right, it's sort of like we're looking at this idea of retirement. My friend over there from Michigan, your dad maybe worked for the union, right? And he had his pension, right? So that was like, what does that really look like? You stated 10,000 people, I think, a day retired. What does that really look like to them? And the way we're talking, it almost seems like 20 years from now, what would that look like? Because we're talking about this gig organization, right? The ability to keep working. So when you put these two things together, is there really retirement? Is it even like, is this whole thing of retirement just be retired? We just work and have a good time? Or
so
it can be miserable, maybe that's the problem.
so this could be my programming, but I think it's about options, freedom, having options to do whatever it is that you just described. And so many people enter retirement today, and it's only trending worse, that people have less and less options. So they dread retirement age because they've been told that retirement age means I'm no longer dependent on a job, or I don't have to wake up and sit in traffic, or do something that maybe they don't love to do. And so maybe retirement needs to be defined to a period in your life when you can do what you love to do. And if that's work, great. If that's golf every day, great. But you need to have the financial resources to execute on that, regardless of today, 10 years, 50 years from now. Because no one's going to hand out, unfortunately, in my opinion, there's not going to be that infrastructure to hand out tickets to go play in whatever arena you want to play in this retirement world. You're going to have to supply your own tickets. And so if you want to talk about what it really means is, in my opinion, it means I can make the rules. I have options to do what I love to do. So, and I think that might hold the test of time.
Leave it open. We're going to actually go to break, but this is the kind of interaction that we're looking for today. So thank you, Bruno. Thank you, panelists.
Thanks for listening. If you enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more great information about this company and other great startups at imagine.nfg.com.